Look at your bank account right now. Look at the number. Now ask yourself, are you getting richer or are you just running faster? Every year you work harder, you save diligently, you make the responsible choices. Yet the finish line of financial freedom seems to move further away. The value of your savings, the capital you built through sacrifice, is dissolving like sugar in water. You've been told that taxes are the price you pay for civilization. But there is a second tax, a shadow mechanism operating in plain sight, an invisible transfer of wealth that is silently siphoning the value from your pocket directly into the hands of the state to finance its colossal debt. This mechanism is not some fringe theory. It is the oldest and most sophisticated trick in the political playbook. It has been used for 2,000 years to destroy empires from within, and it is being executed against you, the ordinary citizen, right now, across the entire English-speaking world. The debt clock ticks not just for the nation, it ticks for the slow, quiet death of your personal financial future. If you don't understand how this mechanism works, you are not a saver. You are simply a subsidized lender to a government that is never going to pay you back in real value. To truly grasp the sophistication of the modern financial system, the one that turns your hard-earned savings into the government's endless ability to borrow, we must first acknowledge its pedigree. The concept of financing the state by devaluing the people's money is not a modern innovation. It is a policy perfected by the Roman Empire. When the Senate or the Emperor needed to pay legions, fund wars, or construct magnificent public works that bought political loyalty, they faced a choice. They could raise open taxes, which risked popular revolt and political suicide, or they could engage in the silent debasement of the currency. The silver denarius, for centuries the backbone of Roman economic confidence, was the victim. In the 1st and 2nd centuries AD, the denarius was nearly pure silver, but over time, driven by constant military expenditure and the ever-growing demands of the empire, emperors began to shave the edges, to clip the coin, and eventually to reduce the silver content entirely, replacing it with cheaper copper. The Roman citizen still received a coin called a denarius, and it still carried the emperor's face, but the actual intrinsic value was systematically hollowed out. By the time of the crisis of the 3rd century, the once proud denarius was less than 5% silver. The government paid its soldiers and its contractors with currency that cost them almost nothing to produce, but demanded the same value in taxes. The soldier, the merchant, the farmer, every Roman holding that money, saw their wealth disappear. Prices soared because the actual supply of real wealth, gold and silver, had not changed, but the number of paper promises, coins, had exploded. This was inflation, not as a natural economic phenomenon, but as a deliberate act of sovereign policy, a hidden tax on the wealth of the middle class. It was the original shadow mechanism that transformed private savings into government solvency. The barbarians didn't destroy Rome's currency, the emperors did. The lesson is undeniable. When a government is addicted to spending, the first thing it sacrifices is the integrity of the money held by its own people. Fast forward to the founding of the modern financial world, particularly within the English-speaking nations. For 2 centuries, Britain and later the United States championed the concept of a sound currency, often tethered to the gold standard. This was a direct historical response to the chaos of past fiat systems. The gold standard, for all its flaws and inflexibility, imposed a crucial discipline. A government could only borrow or spend as much as the gold reserves it could back. This prevented the kind of runaway, Roman-style debasement. It forced political leaders to be fiscally responsible, because every dollar or pound they printed was a promise to deliver gold, a promise that could be tested by markets. For the ordinary saver, the promise was simple. The money you hold today will buy roughly the same or more tomorrow. This created a profound public trust. It anchored the savings of an entire generation, the wealth that was built during the Victorian era and the early American industrial age. That confidence, that bedrock stability, is what allowed the British and American economies to flourish and command global respect. But this integrity became a problem when the state needed to finance ambitions far exceeding its tax base. The gold anchor, designed to protect the saver, became a chain restricting the power of the state. The great pivot arrived with the seismic shocks of the 20th century. The sheer cost of global conflict, World War I and the subsequent Great Depression, provided the necessary political cover and the moral justification to dismantle the shackles of sound money. In 1914, the major powers of the English-speaking world, including Great Britain and the United States, effectively suspended the gold standard to print the unimaginable sums required to finance the war machine. In Britain, the Bank of England moved gold to private vaults and issued paper notes freely. In the United States, the newly established Federal Reserve used the crisis to expand its powers dramatically. This was the moment the shadow mechanism was modernized. It was no longer about shaving silver, it was about printing promises. The citizen bought government war bonds, a moral duty dressed in patriotism, financing the war with their savings, and trusting the government to maintain the value of the currency in which those bonds would be repaid. But the inflation that inevitably followed the printing spree was the true price, a hidden tax paid by every single person who held cash or bonds. Their wealth was transferred to the government treasury to pay for bullets, tanks, and ships. The public debt exploded, and the value of private savings plummeted. The money was still called a dollar or a pound, but its purchasing power, its real value, had been silently hijacked. The war was won, but the financial battle for the integrity of the currency was lost forever. This historical precedent, that a global crisis can be used to permanently expand state financial power, is the core principle that underpins the shadow mechanism that controls your financial life today. The stage was set for a world where your savings are no longer a repository of value, but a readily available debt instrument for the government. The foundational blueprint for the current shadow mechanism was not drawn up during a crisis, but during a period of planned peace, the Bretton Woods Conference in 1944. As the Allied powers, dominated by the English-speaking architects from the US and UK, gathered, they weren't just planning the post-war world, they were institutionalizing the modern debt machine. They established a global system where the US dollar was pegged to gold, and all other major currencies were pegged to the dollar. This made the US dollar the world's reserve currency, a status of unimaginable financial power. This structure gave the United States the extraordinary privilege of being able to run deficits and essentially export its inflation. Every time the US government spent more than it earned, printing new dollars, those dollars were absorbed by the rest of the world that needed them for global trade, oil purchases, and central bank reserves. The US was printing money, but the cost of the devaluation was shared globally. This was the ultimate financial move. The creator of the world's reserve currency effectively had an infinite credit card, paid for by the diligence of global savers. The savings of the American worker were now linked not just to domestic debt, but to the financial ambitions of an entire world order. The shadow mechanism had gone global, and the English-speaking world was its master architect. This system, however, contained an inherent contradiction. The US could not possibly back the entire world's trade and its own ballooning domestic spending with a finite amount of gold. The promise was broken in 1971 when President Nixon announced the temporary closure of the gold window, ending the convertibility of the US dollar to gold for foreign central banks. The global financial system instantly moved to pure fiat currency, meaning the value of the dollar, the pound, the euro, and every major currency was backed by nothing more than the promise of the government that issued it. This was the moment the shadow mechanism achieved its final terrifying form. Money was no longer an asset. It became a pure debt instrument. In a fiat system, every dollar that is created as debt. When a central bank or commercial bank issues a loan, they literally create the money out of thin air, a digital keystroke. And that new money immediately becomes someone else's liability and someone else's asset. But the system's reliance on debt creation is what turns the individual saver's wealth into government spending power. How does this happen today? Through the symbiotic, almost conspiratorial relationship between the government's Treasury and the central bank, the Federal Reserve or the Bank of England. When the government decides to spend $1 trillion more than it collects in taxes, whether for military budgets, infrastructure projects, or stimulus checks, it issues Treasury bonds, or gilts in the UK, which are promises of future repayment, essentially government debt. In a free market, if debt issuance is too high, interest rates must rise to attract enough real buyers, like you through your pension or mutual fund. Higher interest rates would slow the economy, increase the government's borrowing cost, and impose fiscal discipline, something politicians despise. This is where the shadow mechanism is deployed. The central bank steps in and buys a massive portion of that newly issued government debt. This process, known in its modern incarnation as quantitative easing, QE, is the equivalent of the government borrowing money from an entity it controls, which, in turn, creates the new money digitally. This action accomplishes three critical things simultaneously. First, it keeps the demand for government debt artificially high, preventing interest rates from spiking, which protects the government's own budget. Second, it injects vast amounts of new money into the financial system, directly leading to inflation, the quiet debasement of the currency. Third, and most crucially, it makes your savings the victim. As the total supply of money expands dramatically, the purchasing power of every existing dollar or pound you hold is reduced. The government's debt is literally being paid down by the reduction in the value of your assets. The money you saved was based on the value of the money supply before the QE operation. Now that the money supply is inflated to finance the government's trillion-dollar deficit, your savings have been partially sacrificed, a non-consensual transfer of wealth to the state treasury. This mechanism is why the current economic reality for the English-speaking world is one of high national debt coupled with a cost-of-living crisis. The government's political inability to balance its books, its desire to promise every voter more benefits and subsidies, is not met by a politically dangerous tax hike, but by the financially corrosive and politically invisible mechanism of currency inflation. The economic historians who study the fall of Rome recognize the playbook instantly. The only difference is the scale, the speed, and the sheer technological sophistication of the process. This is the shadow mechanism. The central bank acts as the government's silent partner, funding endless spending by diluting the value of the national currency, turning every diligent saver into an unwitting, perpetually exploited lender to the state. The ultimate financial trick is to make you believe that the national debt is someone else's problem, when in fact, you are paying for it every single time you buy groceries, fill your tank, or check your shrinking savings account balance. The system is designed not for your financial security, but for the government's perpetual solvency. The debt machine is a feedback loop, a self-sustaining cycle that ensures perpetual dependence and wealth transfer. Once a government commits to financing its deficits through the shadow mechanism of inflation, it cannot easily stop. The national debt of the US and the UK now stands at levels so enormous that the governments could never repay them in dollars or pounds of the same purchasing power they were borrowed in. They can only be repaid through continuous currency debasement. If the central bank were to suddenly halt the money printing and allow interest rates to rise naturally to a level that would attract real market buyers for the debt, the cost of servicing that debt alone would crush the national budget, requiring impossible tax hikes and devastating cuts to social programs. The political elite has therefore become structurally addicted to the very inflation that is destroying the lives of its citizens. The debt mountain must continue to grow, and the value of your savings must continue to erode simply to keep the existing political and financial structures from collapsing. This is not a failure of policy, it is the policy itself. The most insidious part of this shadow mechanism is how it leverages a second financial trick: financial repression. This is the deliberate effort by the state to keep interest rates artificially low, below the rate of inflation, for an extended period. Look at the return you get on your savings account or certificate of deposit. It is almost certainly less than the official inflation rate, and definitively less than the true inflation rate of goods you actually buy, like housing, energy, and education. This negative real interest rate is a guaranteed loss for the saver. Your bank may advertise a 2% return, but if inflation is 5%, the government is effectively taking 3% of your wealth every year. This is the government's quietest and most effective bail-in, by forcing the middle class and the retired elderly to keep their money in these safe but losing accounts. The government ensures a captive supply of cheap capital, which it can then use to finance its massive debt. The mechanism works like a slow, deliberate leak. The water level of your savings is being reduced, while the reservoir of government debt is being filled. This strategy is only possible in the post-gold fiat money era, where the government controls both the issuance of money and the interest rate on that money. The English-speaking culture, particularly in the US and UK, has a strong historical emphasis on property ownership, financial prudence, and retirement savings. Yet, the current environment has turned these virtues into financial liabilities. The student who took out a loan, the family that bought a home with a 30-year mortgage, the retiree living on a fixed pension, all are victims of the shadow mechanism. The debt they took on was borrowed in dollars of higher purchasing power, and the debt they will repay is in dollars of drastically lower purchasing power. But the journey to get there is an economic war fought against their savings through inflation. The value they meticulously built is sacrificed to service the towering deficits of the state. This is the ultimate great wealth transfer, a phenomenon that history has shown always happens during periods of currency debasement. Wealth does not simply vanish. It is transferred from those who hold passive paper assets, cash standard bonds savings, to those who own hard productive assets, real estate commodities, equity in businesses' infrastructure, and most importantly, to the sovereign issuer of the debt. The question is not if the system will continue, but what you must do to defend yourself against a mechanism that is structurally designed to erode your wealth. History provides the only defense. The survivors of Rome's currency collapse, the German hyperinflation, and the financial chaos of post-war Britain were not the passive savers. They were the ones who understood that money is not wealth, but a claim on wealth. The knowledge derived from the patterns of history, analyzed and amplified by advanced machine learning models, gives us a clear, three-part path to resilience. First, recognize the illusion. Abandon the myth that passive saving in cash or low-interest debt instruments is a path to prosperity. The only thing they guarantee is that you will be the primary source of funding for the government's future borrowing. Second, build real value. Focus on assets that retain or increase their purchasing power when currency declines. These are the productive assets: land, real business equity, rare commodities, and most importantly, skills and knowledge that cannot be debased by a keystroke. Third, master the context. Never trust a politician or a central banker who promises stability while simultaneously running massive deficits. The historical playbook is always the same. They deny the crisis, they inflate the currency, and they blame external factors. Your defense is to see the pattern, understand the mechanism, and act before the next round of quantitative easing is announced. The shadow mechanism that turns your savings into government debt is only powerful as long as you remain unaware of its function. Financial freedom is not given. It is earned by understanding the history the elites prefer you to forget. You have seen the trick. Now you hold the knowledge to avoid being its victim.